It is Ben Graham, of course, whom Warren Buffett credits with most of his success as an investor. Buffett concedes that he was a reasonably successful investor even before he took security analysis, but he adds that learning how to take advantage of what Ben Graham called Mr. Market's sometimes violent mood swings is what created his unparalleled success. Those emotional market excesses create opportunities for patient investors to buy stocks with a margin of safety at depressed prices comfortably below intrinsic values, and to profitably sell them when temporary manic enthusiasms drive prices well above those values. Careful securities analysis and asset valuation expertise show the way. I was hooked. Today, I often find myself introduced to viewers of financial TV as an authority on deal investing. The founder of Gamco Investors Incorporated, a $40+ billion publicly owned asset management and mutual fund corporation, whose success has made my proprietary private market value, PMV, with a catalyst methodology an analytical standard. Gamco's separately managed client accounts have compounded at around 15.5% annually for 40 years, albeit with 4 or 5 down years breaking the compounding chain over that stretch. What's less widely appreciated is that I founded my first arbitrage hedge fund back in 1985, a year before launching our first mutual fund. Called simply the Gabelli Arbitrage Fund, it was funded with just a tad over $9 million, and Gamco now oversees investments approaching $5 billion in ARB strategies. The original Gabelli Arbitrage Fund, renamed the Gabelli Associates Fund, has grown to over $230 million and is part of over $1.4 billion managed in our arbitrage hedge fund strategy. Operating without leverage since we absorbed the brutal lessons of 1987, GAF has compounded its initial capital at an annual growth rate of 7.6% over the 33 years of its existence. What also is often overlooked is that my PMV with a catalyst methodology is actually based on, and is an extension of, Ben Graham's classic value investing strategy, with an overlay of deal dynamics, risk analysis, and sensitivity to the time value of money, which is derived from my appreciation of the compounding magic of the consistent, non-market correlated returns that the risk arbitrage discipline generates. Thus, while our original ARB hedge fund's long-term compound annual return is less, obviously, than the 10% real plus inflation that we target in numerous long-only equity strategies, it's also lower risk. In fact, a conservatively implemented merger ARB strategy like ours actually is a low-risk way to earn an even better absolute return than in a low-cost money fund. On a long-term basis, we hope to earn the risk ARB premium, which historically is about 400 to 500 basis points above the T-bill rate. Pretty much from the arbitrage fund's onset, we have sent letters to our limited partners that detailed individual ARB transactions we are invested in, why we bought it, the hurdle rates, what the risks and rates of return were, the investment rationale. I've always felt that we should be transparent, operating in a fishbowl. Clients should know how we do things. So we communicate about the deals in the fund's pipeline. Our monthly letters always give the investors at least one detailed example of a deal that we think illustrates a very clear path to success. A sampling of recent deal examples is distilled in Appendix 2 at the back of this volume. Even as early as 1985,